Good morning. Welcome to a beautiful summer day from Gimbal World Headquarters in lovely Arts District of Carmel, Indiana.
Yeah, it is the Arts District, and it is pretty. Keith was outside this morning trimming back. What type of plants are those?
Our friend Nancy calls them moonflowers.
They are gorgeous, and we've had a bumper crop this year of moonflowers.
I'll even offer this out there to any of our listeners. If you want an amazing flower, I've got some pods that you can have that will do some great ground covering for you. Just it's a beautiful thing. They close up during the heat of the day and then open up and as the day cools off. They are amazing.
Yeah, they are very cool.
Kind of like our client Nancy that helped us set those up. She's pretty amazing.
For sure. And I tried to. I thought one of them was a weed early on, and I pulled it accidentally. And thankfully, it's grown back just like she said it would.
They are resilient. They are.
Speaking of resilient, welcome back.
It is good to be back. I have this routine that I do. Nobody in here has mentioned it, but I grow a vacation goatee and then I trim it back gradually, kind of like I was doing those flowers. And so this may be the last that you'll get to see it today.
That's not a goatee.
I know it kind of works its way up. So I was impressed nobody said anything in here, but yeah, my family we had dinner together last night and
I'm sure
offered their opinion.
I was gonna say maybe words have been said, you just haven't heard them.
No. They my daughter Kelly was suggesting that I trim it straight across to give it kind of a French kind of look. So I'm sure Connie would have been very appreciative of that addition. Connie loves the goatee. She likes that look, but when we get to the trimming it back thing, she gets a bit curious of what my intents are. So that's part of my motivation in the process, though.
Well, what do we want to look at today? We want to dive into the markets right away.
We might as well, and then we can cover a lot of other ground as well. The markets tend to peak out for the summer rally sometime mid-July, which they've done this year, and then they tend to breathe in and out for the next 60 days or so. So yeah, that's kind of ordinary responses to it. And let's just show the NASDAQ here and let you offer it whatever thoughts you want to say about the NASDAQ today, Doug.
Well, like you were saying, that the August and September months are historically months that are not the stock market's best. But the beauty of the market is you never know what it's going to do. And so the best thing we can do is just get in line with what it's telling us. And right now we're coming off the highs of the year, and it's testing its 50-day moving average, as you all can see there, their red lines. And so probably not too surprising to see some of these stocks within the NASDAQ come out with mixed earnings this past couple of weeks. We've seen companies, technology companies rise. We've seen technology companies fall. They have not been acting in suit. And so we're seeing leadership start to turn over. And maybe it just resets and keeps going. I don't think technology's run out of gas yet, but we are starting to see some of the names give up some steam.
Yeah, I don't know what to make of this. It's just an observation, and it's probably a worthy observation. I don't know if you remember it. I don't even remember how many years ago it was. It's probably been 3 or 4 years ago when oil prices were below zero.
Right. Yeah.
And intuitively, we should have bought oil.
Like everything in oil.
Right.
Yeah.
And we didn't.
Yeah.
And I look back and think about it, I go, it was really obvious, but it wasn't at that moment.
That's right.
And yeah, this is something our friends at First Trust shared with me a couple of weeks ago that I thought I would share with you. The greatest components of the S&P 500 are these 10 entities here. And Apple, Microsoft, Google, Amazon, Netflix, Tesla, Meta, former Facebook, those have been the ones that have driven most of the returns in the market. When we say the market and the S&P 500 and
Yeah.
probably the NASDAQ, they've driven a lot of that performance this year. And what I wanted to point out is the thing over here called the PE, that stands for price earnings. And it's the price of the stock divided by the profitability of the stock. And another way you as investors can look at that number is you can say, okay, if I want to buy $1 worth of profit, how much am I going to pay for that corporation to get $1 of their profits? And, you know, if you're bargain shopping, you don't want to pay a real high number for that. And so these companies that are the big ones here, you're paying $31, $32, $21, $75, $47, $71, and $22. And then these other ones that haven't been really driving all the performance in the marketplace, they're Berkshire, United Health, and then Exxon. They're down below 20. And I would guess as we go even further down into the list of stocks, those forward-looking price earnings ratios are going to be much lower. And we are, I'd say, you know, I would say we're followers of William O'Neill, who passed away earlier this year, and he says that the PE doesn't correlate with what the stock price does, right?
And growth stock, yeah.
Yeah, and what I would throw out there that may or may not be obvious is I don't know if you can really call those top 7 stocks growth stocks. I mean, they've grown at such a high velocity. A second chart.
How much more can they go?
Well, the second chart I was going to show was, and I didn't put it up for everybody today, was how their earnings have been really declining over the last 5 years. Like they're still good earnings, but they're not growing at the level that you would want to pay those kind of multiples for companies. So you can maybe go find the new version of these at similar price earnings ratios and probably have more upside potential.
Well, I don't know how long ago it was that XOM on the bottom, number 10, was number 1.
Was the largest stock. Yeah.
And it wasn't that long ago. I mean, well, maybe 20 years, I don't know. But there are, to your point, there are emerging stocks that are coming up, emerging companies, and maybe they have 100 times forward PE right now.
Right.
But they might make this list and probably will, and then we'll see the cycle down. But to me, what's been interesting about this list is just to see how earnings has affected either growth on a name the last couple of weeks or a sell-off on the name in the last couple of weeks.
Wow. Yeah. And it has been not a exemplary bull market the way a lot of these stocks are taking it. It seems, at least in my circle that I'm looking at, more of them are getting taken out to the woodshed. We saw a local pharmaceutical company get a big boost this week, and it helped the wealth of a lot of Indianapolis people. But as for growth stocks, it's been a real challenging week or so.
Yeah, I think one of the components to growth stocks being challenged, we talked about this last week a little bit, is just stocks have more competition today than they did at the start of this big run a few months ago. Back, what was the low in October? And so today we have more competition, and that's in the form of your money market, that's in the form of bond yields. And if you want to type one in, Keith, type this one in. It's 0 IRX.
0 IRX.
And what we're going to take a look at is this is a short term 1 year basically treasury index, and it's showing here it's at 5.2%. And so what we have is we have short-term money, short-term bond money, paying really amazing rates. And if we go out 5 years, it's 4.3, 10 years, it's 4.1. And so near term, stocks have more competition than they've had in a long time. And really that's what it gets down to is where's the best place for your money? Who's treating it the best? Who's giving you the best bang for your buck on safety and return?
That's, I was looking at similar things. That's funny. We don't kind of we don't mesh up what our conversations are going to be as we're talking. And I thought maybe it's TAT is the one I was looking at now. I can't remember the one I was looking at, but this one is the 20-year. I was looking at the 10-year treasury, and it has a similar symbol to this one. But what I was looking at is that if you go out to a year ago, this ETF that is representing a 20-year treasury was priced, let's go here, price on December 20, well, it's a year and a half ago, almost 2 years ago, but it was priced at $155 a share. And today that 20-year treasury ETF is priced at $95.
Isn't that crazy? And so, like, as we've talked about this, you just saw a picture of the yield on that 13-week, or if you want to, I don't have a 10 or 20-year Keith, but I do have a 5-year. Oh, actually, I do have a 10-year symbol. Oh, you need a 20.
No, 10 years was
Okay, 0TNX. And this is going to be the CBOE index. This is showing yield. This isn't showing.
Oh,
price.
yeah.
So when you're looking at yield, you're saying, wow, looks pretty good,
Right.
But if you flip this chart upside down, that would represent the price.
Right.
Pretty much.
Right.
And so you're showing here what, a 4.1? And so when yields go up, prices go down, and the yield's great. Don't get me wrong, but man, this would have been a ski slope downhill slide if you would have owned that in one of those, ETF indexes.
Oh, yeah. And
It was with quote unquote safe money.
right. And that's the battle for investors today, that if we're with what is called an inverted yield curve, which means you're going to earn more, just like you told everybody earlier, on the shorter term end of the interest rate market. But it's still projecting that the economy thinks we're going to have a recession or a slowdown.
Isn't that interesting?
Yeah.
Yeah, like, I mean, we read a lot of stuff throughout the week, and I get stuck on Twitter from time to time, just reading my favorite people. And very few, I would say, talk about the recession.
Right.
It's more about, hey, we're climbing out of this, numbers are looking good. But when you look at the rates, it kind of tells you maybe a different story, that we're not done yet.
Yeah, and that's really difficult to process, because traditionally with a recession, you have unemployment numbers picking up, and they're not doing that. And what I noticed also is I was looking at some things this week, is productivity is going up, and usually productivity increases as you're heading towards a recession, because when you're in the fat and happy part of an economy, employees are enjoying the labors, because there's just not as much pressure, because there's low unemployment. But when people start letting people go, all of a sudden people start paying attention, and productivity increases. So there's a company called Barstool Sports. I don't know if you saw that this week, that they were owned by Penn, I think, Gambling, and they sold it back, or somehow transitioned it back to Dave Portnoy, the former owner. And he came in the first day that he owned it with a video, and he was cussing up a storm. This was out on social media, that none of the employees were there at 9:45 a.m. or 9:45 in the morning.
Right.
And then he came back at the end of the day with a second video at 5:30. Again, he's cussing about it. He's saying these guys won't even leave now. Like, they won't leave because they got caught. And that's how productivity works, is that when things are fat and happy, people aren't as productive, because they think, hey, I can get another job somewhere else. And so that's how productivity is right now. And so we'll see what happens. It's hard to know what the economy is going to do, but there are signals out there that are out there. I saw, grab my little readers here to see one of them. I saw the Well, one of the things that's going on with the housing market is that in 2023, the first half, only 14 of every 1,000 houses were sold. 14 of every 1,000
What
existing.
year was that?
That's this year. And so that was down from 2 years ago of 19,
Okay.
which 19 down to 14 doesn't seem like a lot. That's a 25% drop in the amount of houses being sold. So that suggests the supply is drying up a little bit. And most of that is because those people got houses at low interest rates and they don't have the freedom and the flexibility to sell it anymore because the cost of buying a house is going to go up quite a bit. And so that's going on in the economy. And then also there's the reality that student loans are going to be kicking back up. Let me see where I had that on my notes here. The student loans are going to kick back up here in the next few days, and the monthly payment for that is going to be about $300, $314 on average for people, which may or may not be a big deal. It's hard to know, but there's these subtle things that are kicking in. Yeah. And what's really interesting in the midst of that, another data point I found, Doug, was that the top 1% of US wage earners earn like $780,000. Okay, that's the top 1%.
Okay.
Well, 824,000. That's my number that's from the Economic Policy Institute. Top 1%. Remember when the media was hammering the top 1%? Well, that's a good income, right?
Oh yeah.
It's not Elon Musk income. It's not Warren Buffett.
No, you don't have a jet with that.
Yeah. So, and you're probably paying a third of that in taxes at some level. So you're probably coming home with $500,000 in the top 1%. Top 10% income in the United States today is 173,000.
Wow.
And that's $280,000, $85,000 a year jobs, which you're going to come in with even a lower amount of that money, because if that's two $85,000 jobs, they're paying a good chunk of that in Social Security.
Yeah.
They've got federal and maybe state income taxes, and they're also probably put money in their 401k.
Healthcare costs, all that
stuff. Yeah.
It
So
doesn't go very far.
So that's the top 10% right now in our, and so what's going on in the other 90%, that $300 that we mentioned for student loans it's going to grind away at that, I think. So there's.
I was thinking of a kid, right out of college. If you get $300 a month, and you probably have a civic payment of $500 a month, and I mean that doesn't go real far.
No, it'll be interesting though, just to see all this, and not only we're talking about the individuals, right?
Yeah.
Well, when the individuals slow down a little bit, they're not spending as much. Maybe the sales tax don't come in.
That's right.
You may not have the property taxes if all of a sudden you see property values dropping down a little bit. So it'll be interesting to see how these different entities will respond to the days ahead.
Well, the market is always trying to be in front of this stuff, and it's looking down the road 16, 18 months and trying to say, hey, where are we going to be? And they're voting on that. And one of the votes that we've shown on here a couple times, but we've never displayed it like this. I want to share with you guys. Keith, if you could go back and switch, we're going to switch from talking treasury bonds and type in this. It's 0BULL. And what this is a investment advisor, bullish, bearish index. This is just the bulls. You could probably go to a weekly. That might maybe tighten it up. Yeah, that's good. Or go to a monthly, actually. See what that does. Okay, so what this is telling you is this is saying this group, the American Association of Individual Investors, produces a survey every Wednesday. And I don't vote on it religiously, but a couple times a month I'll vote on it and say whether I'm bullish or bearish or neutral. And when the survey reports bulls and it's starting to get up around the 60 number, typically that's a contrarian indicator that, hey, this thing might be near its peak and a sell-off could begin. And so this is data, and y'all can find this data out there if you just go to American Association of Individual Investors. And this data is simply saying that people have been pretty bullish.
Yeah.
And what's hard for a lot of investors to do is rotate their thinking. And to take gains or to have stops in place, to have some protections in place. And so as people become more bullish, the greed factor starts to increase. And historically, this is when markets can get a little volatile.
And usually, as counterintuitive as it sounds, is when you're having success is when you start feeling bullish and
Yeah.
kind of strong. And somebody called me this week and said, "Hey, Keith, I was at the gym and this fellow told me he can't wait for this local Indiana pharmaceutical company to split their stock, because when they split their stock, it's going to go up in price."
Okay.
And
Math
so
wins. Did you do some math?
yeah, and so I'm going to just put this price up. We're not recommending this stock. We're not saying sell it or buy it or anything, but it was trading for a long time at this what was that 375 level, and then before that it was really trading over here in the 165 level for a long time, and then we had this big rally into this week that it went all the way up to $530 a share. And so the idea is, hey, if they take this $530 a share stock and drop it to a certain, $75-$80 stock, whatever that is, we split it in half, more people can buy that stock, right?
Yeah.
And what historical data has shown is that when companies start splitting stocks, that's your warning signal to start selling some of it. So and how that works is,
there you go. That was what I was exactly on the tips of my tongue. I wish can we do the A?
let's see here, yeah.
There we go.
Yeah. So what happens,
Look at the price of that. Everybody aim to the top right.
Yeah, $541,000 for Berkshire A.
One share.
One share. And what happens by not splitting the stock is you reduce the supply of shares, because if you bought this at $100,000,
yeah,
which a lot of people wouldn't have done because of $100,000 stock,
right.
You have a $440,000 capital gain, and you're not going to sell it. Most likely, most people aren't willing to take a profit and have that capital gain. So by not splitting the stock, it makes it harder for people to sell the stock, because they have those internal capital gains built there. The more you split them, it's easier to sell a few shares and to not really feel that pressure of capital gains. So Buffett, by not splitting this over years, pretty genius.
It's pretty genius.
Yeah, because he doesn't have to worry about anybody selling it.
He attracts an institutional buyer as well.
Right.
More commas than zeros. So yeah, it's pretty genius.
Yeah. So that's
I can't think of another stock that does. I know there are others that do follow Buffett's type of strategy, but that is fun to look at every now and then.
It looked like a lot of the FANG stocks were going to do that until last year. And if we let's look at what did I do there? Hopefully you didn't lose you.
I think we're still together.
Undo what I did there.
Next top right.
Right here. Nope. Hey friends, we're still here. All right, let's hit this and see what happens.
So we're on, yeah, there we go. We're on that.
That was a lot of fun right there. Which stock was I going to look for? Goodness. Somebody, oh, it was Tesla is what I was punching in here.
Yeah.
Do you see the split?
I
gotta change the date. Let's go to 22. It's the day split last year.
They had that on that chart.
They did. Let me go back to that. Here we go. They did a 3-for-1 a year ago, almost a year ago now. So that would have been priced that day. It was 302. So it was $1,000 a share for Tesla when they split it. And the stock over here was even higher, 1,200 just in January that year. But if we go back to today and multiply it times 3, 3 times 240 is 750. So historically, if you're just looking at the type of things O'Neill said, historically, a split isn't saying go buy more, it's saying pay close attention to what's going on with this stock.
And the pay close attention is the reverse stock split.
Yeah,
When they go from a dollar to $10, or something like that. I can't think of an
hopefully,
example of that.
well, there is, hopefully you guys
Yeah.
aren't, hopefully you're not having any of these in your.
These are, again, we're just Keith and I are having fun and talking about the concepts of splits and reverse splits, and these are not recommendations, but
Yeah, let me look here and see when this one happened. I mean, the stock, this is a stock that did a reverse split here. And most of you probably own some light bulbs from them, or a refrigerator is what I
you
have.
probably owned this at one point in time. I mean, we're talking about going back in time 20 years ago, and who was the guy? Jack
Welch.
Jack Welch. I mean, this would have been top of the S&P 500 back when I first started in the business in 2000, late 90s.
Yeah, and you can see that it really was a stinker for a long time. How's that for a technical word? And it was trading down around 40 over here in a year ago. And if I change this date to 15, it peaked out in 2000 at 51,
60.
61,
60, yeah, 60.
61, which I'm not sure. I guess 61. I have to figure out what the reverse split was to give you a real feel for how bad it did after it peaked out, because you can see over here today, it's come a long way, but it's definitely not made up the difficulties it had there. So that's a reverse split. And let me look that up if you want to offer some other insight while I tell you how much that reverse split was. I'll look that up real quick.
Last thing I was going to say, is now is a great time to meet up with your CPA, or think about, hey, how did it go last year? What would I do differently? Or do I need a recommendation or a referral for a CPA? September is going to be a great month to do that. Things start to get a little busier towards the end of the year for CPAs as they're prepping and preparing. But if you're thinking about meeting with a CPA to talk about your specific tax situation, Keith and we could give you a couple referrals and recommendations. And then also for those of you working right now, remember, October is kind of a big month for your retirement plan or for your healthcare choices. And so just be thinking about how satisfied you are and what changes you might want to make. Feel free to get with me or Keith, and we can talk about your specific situation.
Yeah, let's go back to, I'll show this. This gives you an example of what we were talking about, how stock splits work.
This Yahoo Finance, so you guys can all get on and check that out.
What happened here? It went to I shared the wrong screen. Let me go back to this. I'm having some technical challenges here, not being with you guys for a week or two. Here we go. So this is General Electric, and it peaked out. Remember we were saying that the multiple splits. It peaked out pretty close to May of 2000 when I showed you that.
Scroll down a little bit, you see the different stocks. What's 2 for 1, 2 for 1, 2 for 1, 2 for 1.
And most of them happened in this decade right here.
Yeah, it was rocking. And then you get to the 2000s, 3 for 1.
And then it peaked. It peaked.
1 for 8.
Then August of last year or 2 years ago, a 1 for 8. So you got 1 share for every 8 shares you had. And so if Bogdan, if you're watching, I did this homework for you on the fly here, but definitely stock splits, there's no benefit.
No,
there's no economic benefit to a stock split. It's just a psychological thing.
Yeah.
Well, thanks for hanging out with us today. It's been a lot of fun. Hope your weekend is a spectacular one, and we will look forward to hanging out with you all again next week.
Bye.